Welcome everyone. I'm Bob Klefsis, President of All-Star Financial. I want to welcome you to the All-Star Financial fourth quarter 2013 review and preview with the title Diversification, Not All Boats Rise with the Tide, or Not All Asset Classes Rise with the US stocks. As we know in the past, things don't go up at the same time, and we're going to focus on that a little bit later on. But before we get there, talk a little bit about Bob's Corner in our newsletter. Bob's Corner this quarter talks about the money myths as heard on WCCO radio. Some of you may know that we have a radio show every Tuesday and Thursday, a 90-second spot, where we're talking about myths that have been created by not just the big brokerage houses, but basically by the emotions of people. We'd love for you to log on to our website and see the different cases and white papers that we've written about the annuities that are out there and the myths surrounding those, Social Security and when to take Social Security, index investing, why index investing is not necessarily a good thing, and broker versus fee-only fiduciary, comparing us to somebody who's basically selling product for commissions to 100% no commission. Upcoming topics, next week actually we're going to be starting a divorce campaign that talks about who should you call when you first think about getting a divorce. Many people believe it's a lawyer. We don't believe that that's the case. We believe it should be your financial advisor. And then the topic of gold comes up quite often. Following that, we will have a topic on gold and is it a good investment. So when we talk about market overview for the fourth quarter 2013, diversification, not all asset classes rise like the U.S. stock market did, was really an appropriate title. We had a mixed bag. U.S. stocks were up strong, foreign stocks mixed, and bonds really lost ground. When you look at our four major economic countries, the U.S., Europe, Japan, and China, they're all really moving in the right direction, but is it real GDP growth? We think that that question is yet to be answered. With all of the quantitative easing going around the world, we believe that the real question, or the answer to that is it real GDP question, is still left to be answered. We're seeing the U.S. Fed Reserve tapering on our money easing policy right now. We're going from 85 billion a month in bond purchases down to 75. So we're seeing a monetary policy in Europe, however, that's still pretty active in their easing, and they're a little bit further behind us in the cycle. When we look at the U.S. economy, we look at it as kind of a statement being made as, there's progress, but there's structural issues, as we've talked about. Those issues really are, can the economy be self-sustaining? Is our GDP that's quoted to be up 4.1% actually up 4.1? Is housing strong enough to again stand on its own 2 feet if interest rates rise a bit? And manufacturing and durable goods that were up, is that going to be enough to drive that side of the equation? We see unemployment rate being dropped to 7% on average. I think it's some states are less than 5%. We're right about that 5.2% rate right now. But again, are we really in that situation? When you look at the labor participation rate is down so much, there are some experts that believe our unemployment with the right labor rate numbers would be, participation rate numbers would be closer to 12 to 13%. So the question is, are we adding enough jobs? We see a Fed transition for Ben Bernanke to Janet Yellen, and basically they're going to have to focus and continue to focus on job growth and that suspect part of the economy. So looking forward on the economy, I don't believe that 2014 is going to be the same as 2013. We have still positive growth, as we've mentioned. Employment is down, but is it really? Inflation is low. Can it stay there with as much monetary easing and funny money that's being thrown to the equation that causes the inflation rate to perhaps go up? Corporate profits, margins, and cash, all-time highs. So from that perspective, businesses are spending. Their spending has been up from about 4 to 5% on an annualized basis, but their confidence is still low. So I'm not sure they're going to make the leapfrog in the amount of spending that has to be done to kind of help carry the torch going forward. We look at the bond market and we look at the stability overall. Rates trended higher, but it was more stable than the last quarter. We saw credit-related bonds do better than government-related bonds. High yields were up 3.6%, corporate bonds up about 1%. The yields on the 10-year Treasury did rise from 2.6% to 2.9%, and again, interest rates go up, bonds go down. So we saw the long-term government bonds down about 1% for the quarter, 6 to 9% drop for the year. Same with the TIPS. Bond investors really on the investment demand side also changed their tune to the first time where we had negative assets going into bonds for the first time in many, many years. There were more dollars coming out of bonds than going into bonds. Yet the default rates are very low. So bonds relative to their risk have been a good risk to take. U.S. issued over $1 trillion, the U.S. corporations, over $1 trillion in debt this last year. A lot of that locking in, hopefully locking in at the low rates. Emerging markets issued about $500 billion. So bond side of the world, the supply was fairly large. Again, trying to lock in those rates. Looking forward on the bond side, we would say the trends are going to be likely higher. Being cautious when they're higher, shorter duration, floating rate bonds kind of help a little bit, although they haven't really so far. Diversifying globally also helps. So really our current bond portfolio is all of these and all of this in a nutshell. The bond portfolio as a consequence was really hurt this year, however, because we again have some inversely correlated types of bonds that when domestics are going up, the internationals are going to go down, and vice versa. And remember the insurance side of the equation. All of diversification really comes down to is that we're insuring a loss potential. We're really not worried about that gain potential. Remember, it's not how much you make, it's how much you keep. We're worried about that loss potential. When we look at the domestic stock market, a good transition to that, the year ended with a big bang as it began. And when we look at the U.S. indices and kind of the styles, the Russell 3000, the broadest index that we like, was up almost 34% for the year, a big 10.1% for the fourth quarter, big finish. Growth stocks versus value, very similar for the quarter and the year, up 34 and 33% respectively. Small caps underperformed large caps this quarter, 8.7% to 10.2%, but outperformed and was the best asset class at 39% for the year. Some of our leading sectors for the quarter, industrial stocks did very well, as well as tech stocks, over 12 to 13%. The defensive side of the equation, again, in a more offensive fourth quarter, didn't perform quite as well. Utilities were only up about 3.1%, and REITs were actually down 0.8%. The flow to equities, however, has really helped. And again, that demand has brought these types of numbers to the equation. Can it sustain itself looking forward? I think that's the big question. Environment, again, is very favorable for corporations. Low inflation, interest rates low to help capitalize that future growth when they've locked in those number of bond issues. Earnings are still rising, albeit slower. But I think, again, it's unrealistic to expect 2014 to be the same. And could we be set up for a little bit of a setback? I think we could. Somewhere between that 5 to 10% setback would be kind of a natural progression with the growth that we've seen over the last 5 years in the market and the economy really staying fairly flat over that time period. We look at international markets, they had a mixed picture, but they all lagged the U.S. to one degree or another. Europe was up. We saw export growth boosting the economies over there. European Central Bank is still easing. China's restructuring on the emerging side, even though it's 7% growth, is still projected. That restructuring hurt, and that weakness parlayed itself into hurting U.S. stocks from that real estate side of the world also. Emerging was down for the year. Still strong fundamentals though. We saw reforms in China that we talked about. The negatives were inflation in Brazil and India, and we had political turmoil in Russia, Turkey, and Thailand. So all of those created an environment that was too much volatility, and to have the emerging markets follow suit to the domestic markets performance-wise. But again, we feel that that's something that's going to correct itself when the domestic market goes down and people start looking more for value. So you look at performance in Europe. Europe is obviously just the European continent, up almost 8% for the quarter, a little bit under 26% for the year. EFI is Europe, Asia, Far East, up about 5.7, almost 23 for the year. Japan up about 1.8. So again, a shorter or a smaller growth rate for them, but up 27% for the year. And the emerging countries, as we talked about, kind of lagged everybody internationally and domestically, with only a 1.8% gain for the fourth quarter and a negative 2.6% loss for the whole year. So again, those are, along with China, those things that we believe can bring some value to the table in 2014. Looking ahead, we still see the values are good. Dividends are good. You know, dividends in Europe are probably 3.2 to 3.5% on average. In the U.S., it's about 2.1. So again, we can go for the same dollar, pay about 30% less in cost of earnings, and that yield obviously is about 30% more. Central banks are also still easing over there, so they still have room on their monetary easing program. And Europe is in the early stages of a recovery versus where we're at. We're in that kind of middle, muddling through that middle stage of a recovery. It hasn't really taken hold yet. Emerging markets, again, we think they're a positive to your portfolio, although they were negative to the portfolio this year. The lower level of government debt says that they can grow more efficiently. Higher trade surpluses say that they're manufacturing to a positive level, and that's producing a growing middle class. And just the sheer population, we believe, is going to bring emerging markets to the forefront. The big question could be the year, and I think it will be. So in summary, we've really had a 5-year monetary experiment with the experiment of all that quantitative easing. I don't know if everybody remembers, but back in 2009, QE1 really didn't work. Put a lot of money into it. QE2, after bottoming and going negative on our GDP again, didn't work. Bottomed out about 12 months ago, 12/31 of 12. We were at a 0.4% GDP. We bottomed and shot up a little bit here. So quantitative easing round 3, or what they call infinity, is still in question. They're starting to unwind right now, so they've taken from 85 billion to 75. The big question is, did it work? Will it produce enough jobs to really carry that baton, is really the question. U.S. equities are drawing crowds. When crowds draw and people start running towards, or buffaloes start running towards the cliff, we would say that we want to go elsewhere. I think it's time to go elsewhere, and that elsewhere is Europe and Japan and the emerging countries. So diversifying your portfolio, really, we believe, is going to be king in 2014. It's going to be the key to everybody's success. We're not going to see this unilateral growth in the domestic market. It just can't sustain itself. So when we look at kind of the 5th page of our newsletter, we always kind of have a title to that page. Keep the value of diversification in focus is that focus today. And we want to remind you that diversification really is all about just basically being equal to insurance, where it protects you against something going bad and not all of your assets being lost. Very much like protecting against a car accident or a death or some type of property casualty. 2013, we underperformed equities because we had that protection there. It's not sexy, but it's kind of like a premium. It's an opportunity cost where we're willing not to make as much. Again, it's not how much you make, to basically not lose as much on the downside, and we think that downside potential is certainly there with all of the quantitative easing. Really, the economies have built around sand, and really the markets have been going up really with maybe not a good foundation. So really, that cost for you to protect yourself is what's called diversification. Protects investors when it's needed most, as we talk about, and we have a better compounding effect of our dollar too. Want to go really quickly to this 14-page or 14-year example where we basically produced over that time period 20% less volatility, but gave to our clients about 9.5% more return per $10,000. That's about $1,000 or a 10% better rate of return. So that's and I want to go back real quickly too. Please read our newsletter. We really have that focus when we go back to the diversification and how asset classes move against each other. I really want you to read this because it talks and specifically about diversification and really how it's not really needed until it's needed. So that statement is diversification is one of those things that isn't needed until it is. So just like insurance. So want to talk about kind of our 6th page of our newsletter, our Just for Fun page. Mill Valley Kitchen in Edina is our restaurant recommendation. I don't think I've gone there and ever had a bad meal. Recipe comes from Josiah and his mom's scrambled eggs casserole. We tried it this last weekend, really, really good. And quote of the quarter comes from Robert Cavett. Its character is the ability to carry out a good resolution long after the excitement of the moment has passed. With that, we want to make sure that you understand that we value your relationship. We want to thank you for that valued relationship. We have added a new CPA, Beth, who we loved, had to take a job that paid her more money. Greg Nelson, however, we're just hired, is coming in. He has about 15 years with Arthur Andersen. The last 25 years he's worked for high net worth family offices as their chief investment officer as well as their tax consultant. Very, very good on the high net worth as well on the estate planning side. So we want to welcome Greg to the team. And again, remember, any referrals that you give us, they go back to benefiting you and lowering your fees. So great quarter, a great year. Looking forward to this next year. Theme, don't expect as good a returns, with the realization that things can't go up forever. There's a better chance of having some type of correction this year. So taking some chips off the table is what we've done, and we want to again thank you and really tell you that we appreciate your confidence. It's not how much you make, it's how much you keep, and we think 2014 is going to be one of those keeper years. Have a great day, everybody.